The 10 golden rules of investing everyone should follow. Listen to the full version on the official dinarreport.com website and become our supporter on Patreon. James Royal, Ph.D. Tuesday, November 26, 2024 Bankrate. Investing can often be broken down into a few simple rules that investors can follow to be successful. But success can be as much about what to do as it is what not to do. On top of that, our emotions throw a wrench into the whole process. While everyone knows you need to buy low and sell high, our temperament often leads us to selling low and buying high. So it's key to develop a set of golden rules to help guide you through the tough times. Anyone can make money when the market is rising. But when the market gets choppy, investors who succeed and thrive are those who have a long-term plan that works. Here are 10 golden rules of investing to follow to make you a more successful and hopefully wealthy investor. Rule number 1: never lose money. Let's kick it off with some timeless advice from legendary investor Warren Buffett, who said, "Rule number 1 is never lose money." Rule number 2 is never forget rule number 1. The Oracle of Omaha's advice stresses the importance of avoiding loss in your portfolio. When you have more money in your portfolio, you can make more money on it. So, a loss hurts your future earning power. Of course, it's easy to say not to lose money. What Buffett's rule essentially means is don't become enchanted with an investment's potential gains, but also look for its downsides. If you don't get enough upside for the risks you're taking, the investment may not be worth it. Focus on the downside first, counsels Buffett. Rule number 2: think like an owner. Think like an owner, says Chris Graff, co-chief investment officer at RMB Capital. Remember that you are investing in businesses, not just stocks. While many investors treat stocks like gambling, real businesses stand behind those stocks. Stocks are a fractional ownership interest in a business, and as the business performs well or poorly over time, the company's stock is likely to follow the direction of its profitability. Be aware of your motivation when investing, says Christopher Miser, CEO of Vivaris Capital in La Jolla, California. Are you investing or gambling? Investing involves an analysis of fundamentals, valuation, and an opinion about how the business will perform in the future. Make sure the management team is strong and aligned with the interests of shareholders, and that the company is in a strong financial and competitive position, says Graff. Rule number 3: stick to your process. Experts advise investors to develop an investing process that works for them in good times and bad, and then stick to that process. If you're an investor who wants to dig into the details and you have the time to do so, then use that strength. If you'd prefer to not worry about investing so much or don't have the time, then index funds could be a great option and deliver attractive returns. Either way, stick close to a process that works for you. One of the best strategies for investors: a long-term buy and hold approach. You can buy stock funds regularly in a 401k, for example, and then hold on for decades. But it can be easy when the market gets volatile to deviate from your plan because you're temporarily losing money. Don't do it. Rule number 4: buy when everyone is fearful. When the market is down, investors often sell or simply quit paying attention to it. But that's when the bargains are out in droves. It's true. The stock market is the only market where the goods go on sale and everyone is too afraid to buy. As Buffett has famously said, be fearful when others are greedy, and greedy when others are fearful. Listen to the full version on the official dinarreport.com website and become our supporter on Patreon. Source: Dinar Recaps.